Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Once again, happy Friday, everybody. Hope you guys are doing great. Well, the seasons have changed. It looks like we're coming into the Labor Day weekend here, and so summer is over. And just like the seasons always change, sentiment on what the Federal Reserve is going to do also is just changing a whole lot. My title was, there's a lot of hiking going on, but maybe not by the Federal Reserve, because college football and the NFL has gotten underway, and there's a lot of hiking going on the football field, but really not by the Federal Reserve, because after today's unemployment report, it looks like the Federal Reserve will not be hiking probably in September, definitely probably not in November, because it's right before election, and who knows what's going to happen in December. Remember, last week we saw the notes come out from the Federal Reserve meeting, as well as we had Janet Yellen speaking in Jackson Hole, Wyoming, and she, along with Vice Chairman Fisher, had seemed to be preparing the market that the Federal Reserve really wanted to increase credit and got a lot more hawkish, and so expectations were for the Federal Reserve maybe to increase as early as September. Well, again, the unemployment report came out today, and it was a disappointment. Expectations were for about 180,000 jobs added to the economy. The actual number only came in at about 151. The unemployment rate actually stayed at 4.9%. Labor force participation rate also stayed at what it was last month at 62.8. So this wasn't a horrible report, but it just wasn't as strong as previous reports, and that combined with other economic data that's come out with the market, it's not showing that the economy is on a tear, and that the Federal Reserve probably will need to maintain that accommodative policy. And so what is happening, usually a lower jobs number would actually be good for interest rates. Today, that's not really the case. It's not hurting it terribly, but rates finished the week actually just slightly worse than where they ended last week. We do see interest rates under a little bit of pressure today, which again is counterintuitive. And the reason is that the stock market loves this accommodative policy. And so the stock market is doing quite well. It's been maintaining some of the all-time highs. It's very close to the all-time highs. So the stock market is doing well. Mortgage-backed securities aren't performing well in light of a disappointing jobs numbers. Now, here's what's also happened in the week in terms of economic data. We saw personal spending. That was up 0.3%, just as expected. We saw the PCE, which is the Fed's favorite gauge of inflation, and that's personal consumption expenditures. And that showed only a 0.1% increase. So it shows that inflation is very, very mild. We also did see consumer confidence up slightly than what was expected. Pending home sales were up dramatically. We saw an increase of 1.3%. Expectations were only for an increase of 0.7%. So good news in the housing front on the overall global, or not global, but at least the United States economy, showing that, again, housing is a real bright spot. And we did see the Case-Shiller index come in, and once again, Denver was number 3 on the appreciation scale. We saw Portland come in at the highest at just a rip-roaring 12.6% increase. Seattle was next at 11, and Denver was third highest at 9.2, showing that appreciation, as we all know, is happening here in Denver. It's almost an unsustainable number, so we hopefully will see these come down a little bit, because we don't want this bubble. But again, housing is just doing well all across the board, and Denver continues to be one of the most impressive markets in terms of appreciation in the whole country. So again, interest rates are still phenomenal. We're not seeing any benefit with a weaker than expected employment report like we normally would, just because it looks like the stock market loves this accommodative policy. So that's, and we'll just portend to my prediction that once the Federal Reserve does start tightening, and they really want to, and they're tightening because not so much the economy is doing great, but they want to put some more bullets back in the gun to ease credit at a future date when we do experience more of a falter in our economy. So this accommodative policy is what everybody is reacting to. And once we do see the Federal Reserve increase credit, it will help to maintain low interest rates, and they're already low. So it's just a little bit different world here right now. But probably no hiking going on by the Federal Reserve anytime soon. All this can change, and we'll keep you informed. I hope you have a wonderful Labor Day weekend. If you are working this weekend, so are we. So if people are out there looking for homes and need some help, please feel free to give us a call. And as always, we'll keep you informed as what happens next week with interest rates. Happy Friday. Hope you guys are doing great, and we'll talk to you soon. Bye-bye.